Well, we're officially in a crash. The S&P 500 is down 25%, the Nasdaq is down over 30%, and the Dow Jones is down 18%-ish, give or take. This is not fun. Typically, a 5% pullback is something we could just brush off. 10% is a normal correction to be expected at times. But 20%, a full-on bear market and crash, that's just really painful. And if you've been overweight growth stocks this entire time as well, then you're feeling even worse. So the question is, have we faced the bottom of this bear market? Well, if we look back at history, Black Monday had a loss of 58%. The dot-com bubble was down 77% over a 2-year period of time. Even blue chip tech stocks like Cisco, Intel, Oracle lost more than 80% of their value. Now let's layer in some of the other risks that the market's dealing with, starting with the Russia-Ukraine crisis, which doesn't seem to be settling down all too much at this point. We have gas prices at all-time highs, which is just destroying the consumer. Inflation is through the roof. It's the worst it's been since the 70s, and we are at a major risk of being in a recession. We could actually already be in one and not even know it. Oh, and let's not forget the almighty Bitcoin, the store of value, as they'd say, which is just collapsed upon itself. There are plenty of reasons why investors can be fearful right now, but here's the point I want to make. 20% downturns or 20% corrections or crashes don't happen that often. In fact, there have only been 5 or 6 crashes in the past 100 years. Those include the Great Depression of 1929, Black Monday in 1987, the dot-com bubble in 2001, the financial crisis in 2008, the COVID crash in 2020, and then now, which doesn't have a name, but if I could name it, it'd be the please God let us stop bleeding. If you're in your 20s, 30s, or 40s, this is an opportunity. This doesn't happen that often. Now, it may feel like one of the scariest moments that you're going through, or just complete nonsense or craziness to be investing in a downward market, but this is a moment. People naturally have the urge to sell their stocks, funds, bonds, fill in the blank, when there's a downturn. It's natural, it's inherent. All they want to do is stop the bleeding. The fear is just too much for them. And that's when people make mistakes. People end up selling at the worst time that they could. They end up selling when they're down. The same people were buying Tesla at $1,500 thinking that it was at a really good value, but now that it's half the price, they're scared to enter in. Doesn't that just seem weird? Doesn't that seem a little bit odd to you? One of the greatest investors of all time, Warren Buffett, said, "Be fearful when people are greedy, and greedy when people are fearful." And based on the way the charts are right now, guys, I think it's safe to say you can be a little bit greedy. Now, I'm not saying throw your money into the market without any regard to your long-term objectives, your goals, your risk tolerance. But what I'm saying is you can be strategic, you can be selective right here, and you can find really good opportunities for you in the long term. The potential for a recession and a downward market creates investment opportunities. When the market's trading down or sideways, I generally point people towards higher quality company stocks that are paying dividends. Companies with good balance sheets that have positive free cash flow and pay you a dividend just by holding on to them. I find those to be more attractive in this type of market. Now, security selection is obviously important, but I also recommend oftentimes that people do a dollar cost averaging schedule into their investment position. Dollar cost averaging is when you're buying into the market no matter if it's going up or down, not looking at the exact price, but just buying in on a consistent basis, whether it's once a month, once a week. Now, there's no guarantees that dollar cost averaging is going to put you in a better position than if you were to just dump all your money in at once. But what it does is, if you think about it in a mathematical fashion, if you're buying into a market as it's going down, you're buying in at lower prices. And when the market inevitably corrects and starts to move upwards, your overall average price can help build a strong cost basis for you that's a really good foundation for you later on in life. The one thing I don't recommend people do is try and time the bottom or try and time the market in general. Now, I know that sounds crazy right now because honestly, the last handful of years, we've been living in an investment environment, a market where it was very, very easy for people to trade and make money. You could know nothing about the market, nothing about a stock or security, buy it, hold it for a period of time, sell it, and make a profit. It was easy money. We're not in that type of environment anymore, guys. When you're trading in an upward market, it's pretty easy to buy and then sell something a little bit higher. But now think about this on the flip side. When you're trading in a downward market, you're buying something, a lot of times you're buying something higher and then you're selling it when it's getting lower. That's the exact opposite of what you want to do. You really want to buy low and sell high in the perfect world. The thing is, nobody has that crystal ball. Nobody has the magic wand or the unicorn that's sitting in their closet telling them what investments to pick and when to buy them and sell them. We just don't have that. So unfortunately, I wish I did. It'd be awesome, but we don't. So you need to think about it in more of a disciplined fashion, more of a strategic way. How are you going to enter into this market and build up your cost basis right now? Remember, bear markets are for investors, not for traders. Traders, you're going to get beat up in a downward market. But longer term investors, this is built for us, guys. This is built for longer term buy and hold strategies. If you want higher than average returns in the long run, you have to invest in a downward market. It's counterintuitive, it's scary, but it's the only way to do it unless you do have the crystal ball that tells you when you're going to buy at the bottom. But nobody has that. But if you really want to have higher returns on average in the long term, you have to invest in a downward market. It's the only way to do it. If you're not sure what you should be investing in, feel free to click the link in the description down below. We can have a one-on-one consultation and figure out what's most appropriate for you based on your goals, your asset allocation, your risk tolerance. We can figure all that out and determine what's a good portfolio for you, what type of securities are best. This is something I do every single day. I manage assets in portfolios. I help people retire. I do their financial planning. So working within a market that's volatile like this, it's something that happens that you need to be prepared for and have the right team on your side. Now, I don't know when the bottom is coming. I think that it's going to be pretty bumpy and could be pretty painful for the next year or so. But this is a great time for you to be building up your cash position and be building up your cost basis within quality companies. That's what I'm doing right now. I've been buying into some other quality companies and building up another cash position on the side. If you're not sure, which one of those companies or stocks is best for you, then feel free to subscribe to the channel because I will be talking about different stocks along the way. So I appreciate your time, guys. Don't forget to like, share, and subscribe to the channel for more detailed stock analysis and update on the markets. I will catch you guys next week. Take care.